Picture this. You've been investing consistently for 15 years. Every month, like clockwork, money goes into your retirement account. You've watched it grow from nothing to $500,000. Then one morning, you check your balance and $200,000 is just gone. 40% of your life savings vanished in what feels like an instant. This isn't some hypothetical nightmare scenario. This has happened multiple times in recent history, and it will happen again. The question isn't if you'll experience a major market crash during your investing lifetime. It's what you'll do when it happens. And here's the thing most people get completely wrong about market meltdowns. The drop isn't the danger. Your reaction to it is. Understanding this distinction is the difference between building wealth and watching it evaporate. Let's break down exactly what happens and what you can do about it. When you think about a 40% market crash, what comes to mind? Maybe you picture grainy black and white footage from the Great Depression, people in suits lined up outside banks, life savings evaporating into nothing. Or perhaps you imagine something more modern, panicked traders on Wall Street, retirement accounts decimated, years of careful planning wiped out in a matter of days. But here's what most people get completely wrong about market crashes. They're not rare, apocalyptic events that happen once in a lifetime. They're a normal, almost predictable part of investing that you will almost certainly experience if you stay in the market long enough. Let me put some real numbers to this. Since 1980, the S&P 500 has dropped 40% or more from its peak 4 separate times. The dot-com crash saw a 49% decline from 2000 to 2002. The 2008 financial crisis brought a devastating 57% drop. In March 2020, the market plunged 34% in just 33 days, the fastest decline in history. This isn't ancient history. This is what investing actually looks like when you zoom out beyond the highlight reels. Here's the thing that separates people who build wealth from people who get destroyed by volatility. It's understanding the difference between paper losses and realized losses. When your account drops 40%, you haven't actually lost 40% of your money. You've lost 40% of its current market value. That's not the same thing, and this distinction is absolutely crucial. Think about it this way. Imagine you own a house and the housing market crashes. Your home is still there, you can still live in it. The only way you actually lose money is if you sell during the downturn. The exact same principle applies to your retirement investments. Those shares you own represent real ownership in real companies. When the market crashes, you still own the same number of shares. The price tag has changed, but your actual holdings haven't. Now, some of you are probably thinking, but what if this time is different? What if the market doesn't recover? These are legitimate questions, and they're exactly what runs through every investor's mind during a crash. The fear feels completely rational in the moment. But here's what history tells us. Again and again, the market has recovered from every single crash in recorded history. Every single one. The Great Depression, 2 world wars, oil crises, a global pandemic. The market took its hits, and it came back. That doesn't mean recovery is instant or painless. Watching your account bleed red for months or even years is genuinely difficult. But understanding that you haven't actually lost money until you sell, that's the foundation that makes everything else possible. And here's where it gets really interesting. The mathematics of how crashes work might completely change how you think about these events. Block. Section 1. Word count approx. 480 words. Here's something about market math that changes how most people think about crashes. The thing about a 40% loss that your gut doesn't naturally understand. The math for recovering from a loss is not symmetric with the math for experiencing it. When your portfolio drops 40%, you don't need a 40% gain to get back to even. You need a 67% gain. Let's break that down. If you had $100,000 and it dropped to $60,000, you need to earn $40,000 on that $60,000 base to recover. That's 67%, not 40%. This asymmetry is why losses feel so devastating, and why many people assume recovery is nearly impossible. But here's where this gets really interesting. Time changes everything. The stock market has historically returned somewhere between 7% and 10% annually over long periods. Using a conservative 8% for calculations, how long does it take to recover from a 40% crash? About 6 to 7 years. Now, 6 to 7 years might sound like forever when you're staring at a devastated account balance. But think about it this way. 7 years ago, were you the same person you are today? Time has a funny way of passing whether you're watching your investments or not. Here's the crucial variable that most people don't factor in: your time horizon. Imagine you're 35 years old with 30 years until retirement. A 40% crash is a completely different event than if you're 63 and planning to retire in 2 years. For the 35-year-old, that crash represents a temporary paper loss that will likely recover multiple times over before they ever need the money. For the 63-year-old, the math is genuinely more complicated, which is exactly why asset allocation matters so much as you approach retirement. The point is this: compound growth doesn't care about your emotions. It doesn't care that you're scared or that the headlines are screaming about financial apocalypse. If you give it enough time, it does what it has always done. Those shares you own, the ones that just dropped 40% in value, they're still generating earnings, still paying dividends, still representing real ownership in real businesses. The price tag changed, but the underlying engine didn't stop running. Think about what this means in practical terms. If you're investing $500 per month and you have 25 years until retirement, a crash that happens today will likely be completely invisible in your final portfolio. Not because the crash wasn't real, but because 25 years of compound growth will have so thoroughly overwhelmed that temporary decline that it becomes a footnote. The math doesn't lie, even when it requires more patience than our microwave society typically appreciates. But if the math works out so clearly, why do so many people still end up with terrible investment returns? The answer isn't in the numbers. It's in what people actually do when they experience a crash in real time. Let's look at what actually happened to real money in real crashes. History has run this experiment multiple times, and the results might change how you think about market meltdowns entirely. Start with the 2008 financial crisis, the crash that defined a generation of investors. From its peak in October 2007 to its bottom in March 2009, the S&P 500 fell approximately 57%. If you had $100,000 invested at the peak, you watched it drop to roughly $43,000. That's not a typo. More than half of your portfolio value gone. Headlines screamed about the end of capitalism. Banks were failing. People genuinely wondered if the entire financial system was going to collapse. But here's what actually happened next. The market bottomed in March 2009. And by March 2013, just 4 years later, it had fully recovered to its previous peak. By 2019, it had more than tripled from that terrifying bottom. Someone who had $43,000 at the worst moment of the crisis and simply held on was sitting on over $130,000 a decade later. The crash that felt like the end of the world became a footnote in one of the greatest bull runs in market history. Now let's look at something even more dramatic: the COVID crash of March 2020. The market fell 34% in just 33 days, the fastest decline ever recorded. Imagine checking your retirement account on February 19th, 2020, and then checking it again on March 23rd. In barely a month, more than a third of your savings had evaporated. The fear was absolutely rational. And then something remarkable happened. The market didn't just recover. It recovered faster than anyone predicted. By August 2020, just 5 months after the bottom, the S&P 500 had completely erased its losses. People who panic sold during those terrifying weeks in March locked in their losses permanently and missed one of the fastest, most powerful recoveries in market history. The dot-com crash tells a slightly different story, and it's important to understand why. The market fell about 49%. But unlike 2008 or 2020, the recovery was slower. It took until 2007, roughly 7 years, to return to previous highs. For investors who needed their money during that period, the extended timeline was genuinely painful. But here's the pattern that emerges across all of these crashes. The market recovered. Every single time. The timeline varied. The path was different. But the destination was the same. Patient investors who held their positions came out the other side with their wealth intact, and often significantly grown. So if history is so clear, and the math so straightforward, why do so many people still end up on the wrong side of these recoveries? Most people think it's about picking the wrong investments or bad timing. They're completely wrong. The answer lies in something far more fundamental. And it's something that actually works in your favor if you understand it. Here's where this gets really interesting, and honestly a bit counterintuitive. Most people see market crashes as pure destruction, something to survive and escape from as quickly as possible. But they're missing something important. For investors who are still in the accumulation phase, still adding money to their accounts every month, crashes represent one of the greatest wealth-building opportunities you'll ever encounter. Here's exactly how this works. Imagine you're investing $500 per month into your retirement account, and then a 40% crash hits. Your existing balance takes a hit, obviously. But here's the thing about your ongoing contributions. When you invest that $500 next month, you're buying shares at a 40% discount. The month after that, maybe shares are still down 35%. You're still buying at a massive discount. Every single contribution during the downturn is purchasing more shares than it would have before the crash. Think about it like shopping. If your favorite store announced everything was 40% off, you wouldn't run away in panic. You'd stock up. The exact same logic applies to investing, except it feels completely backwards because we've been conditioned to see red numbers as bad. Let's put real numbers to this. Say the market drops 40% and stays depressed for 2 years before recovering. During those 2 years, you continue investing $500 per month. That's $12,000 total. At normal prices, that $12,000 might have bought you 100 shares. But at crashed prices, that same $12,000 buys you 150 or 160 shares. When the market recovers, you don't just get back to where you were. You end up significantly ahead because you own substantially more shares than you would have without the crash. This is the hidden math that makes market crashes work in your favor over long time horizons. The shares you accumulate during the downturn have disproportionately large growth potential because they were purchased at depressed prices. Those cheap shares become the engine of future wealth in ways that regular priced shares simply cannot match. Here's why this matters so much for your 401k. If you're getting employer matching contributions, those matches are also buying at crashed prices. Every dollar your employer puts in during a downturn is working even harder for your future. Stopping your contributions during a crash doesn't just mean you miss out on cheap shares. It often means you miss out on free money from matching. The people who understand this principle and act on it will come out of crashes wealthier than they would have been without them. The people who pause their contributions, or worse, sell their existing holdings to stop the bleeding, permanently sacrifice this opportunity. Now, this feels wrong. Every instinct in your body screams that you should stop putting money into something that's losing value. But those instincts evolved for a different world, one where losses were permanent and dangers were immediate. Investing doesn't work that way. And here's where most people make the critical mistake that actually destroys their retirement savings. The market recovered from 2008. It recovered from 2020. It recovered from the dot-com crash and every other major decline in history. But here's the thing that most people don't realize. Many of the investors didn't recover. The market came back. Their portfolios never did. And understanding why this happens is absolutely critical to protecting your own retirement savings. The real danger during a market crash isn't the crash itself. It's the behavioral trap that catches millions of investors every single time. When your account drops 40%, your brain doesn't calmly calculate recovery timelines and historical precedents. It screams at you to do something. Stop the bleeding. Get out before it gets worse. This feels completely rational in the moment. It feels like survival instinct. It's actually the single most destructive financial decision you can make. Here's what happens when you sell during a crash. You lock in your paper losses as permanent, realized losses. That 40% decline that existed only on paper becomes a 40% decline that you can never recover from. But it gets worse. After you sell, you have to decide when to get back in, and this is where the real devastation occurs. Most people who sell during crashes wait for things to calm down before they reinvest. They want to see stability. They want confirmation that the worst is over. But by the time things feel calm and stable, the market has usually already recovered a significant portion of its losses. Studies consistently show that the best days in the market often come immediately after the worst days. Miss those recovery days, and you miss the engine that drives long-term returns. Research from behavioral finance firms tells a sobering story. The average investor earns significantly less than the market over long periods, and the gap isn't small. Some studies suggest the difference can be 3 to 4 percentage points annually. Over a 30-year investing career, that gap can mean the difference between a comfortable retirement and a precarious one. And the primary cause isn't bad stock picks. It's selling low during crashes and buying high when things feel safe again. Here's this in concrete terms. Imagine you had $500,000 invested and the market dropped 40%, taking your balance to $300,000. In a panic, you sell everything and move to cash. Over the next 6 months, The market recovers 30% of its losses. By the time things feel stable enough for you to reinvest, the market is back to $390,000. But your cash is still $300,000. You missed the recovery. You're buying back in at higher prices with less money. The math is brutal. If you had simply held on, your $300,000 would have grown with the market. Instead, you're starting from behind and will never catch up to where you would have been. This is how crashes destroy retirement savings. Not through the decline itself, but through the perfectly understandable, deeply human response to that decline. And understanding why our brains push us toward this mistake is the first step toward avoiding it. So if staying invested during a crash is mathematically obvious, why is it psychologically almost impossible for so many people? Understanding why our brains work against us is the first step toward not making the same mistake. The core problem is something researchers call loss aversion. Think about the last time you found $20 on the ground versus the last time you lost $20. The pain of losing feels roughly twice as intense as the pleasure of gaining the same amount. This isn't a character flaw or a sign of weakness. It's how human brains are wired. Our ancestors who were highly sensitive to losses survived. The ones who weren't didn't. But here's the thing. This survival instinct that served us well on the savannah works against us in financial markets. When you see your account balance plummeting, your brain interprets it as a genuine threat. The stress response kicks in. Cortisol floods your system. Your thinking narrows to immediate danger and escape. In that state, making calm, rational decisions about 30-year time horizons becomes nearly impossible. Then there's recency bias. Our brains naturally assume that whatever is happening now will continue happening forever. When markets are crashing, it feels like they will keep crashing indefinitely. Every headline confirms the narrative. Every chart shows the decline continuing. The idea that this is temporary, that recovery is coming, feels like naive optimism in the face of clear evidence. Social proof makes everything worse. When everyone around you is panicking, staying calm feels insane. Your coworkers are talking about moving to cash. Financial news is wall-to-wall catastrophe coverage. Your brother-in-law sold everything last week and is smugly telling everyone he got out just in time. The pressure to do something becomes overwhelming. And then there's the action bias itself. Humans are wired to feel that doing something is better than doing nothing, especially in a crisis. We want to take control. Selling feels like taking action. Holding feels passive and helpless. But in investing, the passive choice is often the correct one. Here's the uncomfortable truth. Knowing all of this intellectually doesn't make you immune to it. When the crash comes, when your screen is full of red numbers and the headlines are screaming about financial collapse, you will feel the urge to sell. Everyone does. The question isn't whether you'll feel that urge. The question is whether you'll have systems in place that prevent you from acting on it. This is where preparation becomes everything. The investors who survive crashes aren't the ones with superhuman willpower or ice in their veins. They're the ones who made their decisions before the crash happened, when they could think clearly and built structures that prevent them from making impulsive choices in the heat of the moment. Understanding the psychology is important, but building the right framework is what actually protects your wealth. Here's what separates people who come out of crashes wealthier from those whose retirement savings never recover. It's not intelligence. It's not insider knowledge. It's not even willpower. It's preparation. The work that protects your wealth happens before the crash, not during it. The first and most fundamental protection is an emergency fund. This sounds basic, almost boring, but it's absolutely critical. You need 3 to 6 months of living expenses sitting in a savings account, completely separate from your investments. Here's why this matters during a crash. If you lose your job or face an unexpected expense during a market downturn, you need cash to cover it. Without an emergency fund, you're forced to sell investments at the worst possible time just to pay rent. That's how temporary paper losses become permanent realized losses. Your emergency fund is what allows you to leave your investments alone when everything is falling apart. The second layer of protection is asset allocation matched to your timeline. If you're 30 years from retirement, having most of your portfolio in stocks makes mathematical sense. You have decades to recover from any crash. But if you're 5 years from retirement, that equation changes dramatically. You need a larger allocation to bonds and stable assets because you don't have time to wait for recovery. This is where the bucket strategy becomes genuinely valuable. The idea is simple. Keep 1 to 2 years of living expenses in stable, low volatility assets that won't drop significantly in a crash. This is money you can live on during a downturn without touching your stock investments. When the market crashes 40%, your long-term holdings can stay invested and recover over time, while your near-term spending needs are covered by assets that haven't been affected. But perhaps the most powerful protection is making your decisions before the crisis hits. Write down your investment strategy when you're calm and thinking clearly. Include specific rules for what you will and won't do during market declines. Some investors even write letters to their future panicked selves, explaining why they should stay the course. It sounds silly until you're in the middle of a crash and your brain is screaming at you to sell. Automatic investing helps enormously. If your 401 contributions happen automatically from your paycheck, you don't have to make the decision to invest every month. The choice is already made. During a crash, you'll keep buying at lower prices without having to overcome your fear each time. Here's a framework that helps many investors. Ask yourself what you would regret more. Would you regret more selling and missing the recovery, or holding and watching your balance decline further? For most people with long time horizons, the regret of selling and missing out is far greater than the temporary pain of paper losses. That clarity can help you hold on when everything feels like it's falling apart. So let's bring this back to that morning we started with. You wake up, check your retirement account, and see that 40% is gone. Your stomach drops. Your mind races. Every instinct screams at you to do something. But now you understand what's actually happening. Paper losses aren't real losses until you sell. History shows that crashes end and recovery follows, sometimes faster than anyone expects. The real danger isn't the market dropping. It's the perfectly human, deeply understandable response to that drop. And the investors who come out ahead aren't the ones with nerves of steel. They're the ones who prepared before the crash happened. Here's the thing about the next market crash. It's not a question of if, but when. At some point in your investing lifetime, you will experience a significant decline. Maybe 30%, maybe 40%, maybe worse. The math tells us it's inevitable. The only question is whether you'll be ready for it when it arrives. There's a strange irony at the heart of all this. Crashes feel like emergencies requiring immediate action. Every headline, every chart, every conversation with worried friends and family will pressure you to do something, but the mathematically correct response to a crash is almost always to do nothing. To hold your positions, to keep investing, to let time and compound growth do what they've always done. The math doesn't care about your feelings. It doesn't care about the headlines or the panic or the fear. It just keeps working, the same way it has through every crash in market history. And honestly, that's actually good news. It means you don't need to predict the future or time the market perfectly. You just need to stay invested long enough for the mathematics to work in your favor. Think about what this means for your future. Years from now, when you look back at the next crash, one of two things will be true. Either you'll have prepared for it, stayed the course when it happened, and watched your wealth recover and grow beyond where it was before. Or you'll have panicked, sold at the wrong time, and spent years wondering what your retirement could have looked like if you'd just held on. The same crash, two completely different outcomes. The only difference is what you decide to do before it happens. The math doesn't lie, even if it requires more patience than our instant gratification culture typically appreciates. Start building your crash-proof foundation today, because when that morning finally comes, you'll either be thanking yourself for preparing or wondering what could have been, and by then, it will be too late to choose.